While we wait for the Fed statement, let's turn to our roundtable of former Fed officials. Alan Blinders, the former vice chairman of the Federal Reserve. He's now a professor of economics at Princeton University. Vince Reinhart, former director of monetary affairs at the Fed, now a resident scholar at the American Enterprise Institute. Welcome to both of you. Alan, let me start with you and ask you, there's two constituencies today, the market and the members of the Senate Banking Committee. I don't imagine, Alan, that Ben Bernanke wants to upset either constituency.
I don't think he'll be talking to the Senate Banking Committee too much today. Those issues have to do with financial reform, including the role of the Fed in the financial reform. They're not going to be on the FOMC agenda for today. That's not to say they might not talk about it a little bit over sandwiches, but it's not going to be the agenda item, and it's not going to be in the statement. So they'll be talking to the markets, your first constituency.
And Vince, housing's improved, manufacturing's improved, a lot of inventories are being rebuilt, but unemployment is still rising. Unemployment at 9.7%. What's the Fed watching at this point? What's the most important indicator that people should be looking at? What will they be talking about in the statement and when we get the minutes in 2 weeks?
Well, I think you heard Chairman Bernanke tell us what was important to him last week when he had the opportunity to talk about the outlook. It was unemployment all the time. What he said was the economy was only technically in recession and that the unemployment rate was high and was likely only to come down gradually. So he's really signaling that he doesn't want market participants to get out ahead of the Federal Reserve. They've got an outlook in which there is some slack. The slack persists, and inflation isn't a material risk for a while. So what are they looking at? Inflation compensation to make sure they're right on that assessment, and unemployment.
Alan Blinder, as Michael and Vince were talking about the unemployment rate, we note that the Fed's never raised rates when unemployment is rising. What's the strategy then? How do you combat this?
Well, I think they'd like not to raise rates when unemployment is rising, and hopefully that'll be not so hard to do because the rise in unemployment won't last that much longer. At least that's the way it looks, and certainly the way I hope. On the other hand, they're clearly going to have to raise rates when unemployment is high, not rising anymore, but high. I don't know if that means 9%, 9.5%, 8.5%, but something way, way above full employment. That's always an uncomfortable position for the central bank, and it'll be an uncomfortable position this time, too.
To come back to the statement today for just a minute here, Vince, Alan was talking about how the Fed is really kind of speaking to the market here. If that's the case, would you be shocked to see really very little or even no change in the statement?
I think it's an institution that wants to keep a pretty low profile. It is talking about its exit strategy because it wants to reassure people that it does have a plan and inflation won't get out of control. But in the near term, they've got a pretty subdued outlook, and they've got no reason to change the stance of policy. So I would suspect what they're going to do is the minimal amount of updating to bring up the assessment of the economy up to date. Not a lot has changed there. And then maybe on some advance notice on their mortgage-backed security purchase plan. But that's about it, as little as they can get away with.
I want to ask Alan about that mortgage-backed security plan. They could wait until November. Would you think they would do it this meeting, and what's the advantage?
To me, it's kind of a coin flip. The advantage is that you let people know what's going to happen with a greater lead time, and that presumably gets people prepared for what they either want to do or don't want to do. I basically agree with what Vince said. At this point in time, I think probably the FOMC is going to have a relatively vigorous debate internally because I think the hawk-dove bifurcation is starting to matter again. For a long time, it didn't matter, but they're certainly not anywhere near ready to raise interest rates, and I think they want to issue a statement that will bore people today. It should be a really boring statement. The main change, I think, will be an upgrading of the state of the economy. They said something last time about activity is leveling out. Well, as Chairman Bernanke said the other day, it's doing a little bit better than leveling out right now.
Right, Alan Blinder, Vince Reinhart, stand by. All of our guests will be staying with us as we wait for that Fed statement, which is scheduled to come up in about 3 minutes from now. But let's head over to the Chicago Merc and get a look at the stock and bond markets before the Fed's decision. Kevin Cook, a trader at Peak 6 Investments, joins us now. And Kevin, thanks for your time. And what are you expecting to hear this afternoon?
Well, as most of your experts just said right there, we're not going to hear much. I like to talk about Bernanke's bet that he made at the beginning of the year. which is that deflation is a bigger risk to this economy than inflation. And I don't think that bet has changed for him. You listen to Bill Gross from PIMCO, and he talks about the Fed never raising interest rates in a mild recession until 4 months after unemployment peaks. Well, unemployment hasn't peaked, and Ben Bernanke is definitely looking at that. I also speak of Ben Bernanke's trim tab here. He's very moderate. He understands the language game here with the statement, and he makes gradual changes to both policy and his language. So we might see them talk about signs of recovery, but they're going to still err towards economic weakness. Right now, we're looking. We trade the Eurodollar futures here at the CME, and that forward curve is telling us that we may not see short-term rates at 2% for another 18 months. So that's a gradual climb well into 2010 and 2011.
Okay, Kevin, thanks a lot. We're going to ask you to hang around just as everyone is. We're all standing by waiting for that statement. In the meantime, let's go to the markets desk. Michael Whitney will give us a look at the dollar, gold, and the commodities markets ahead of the Fed statement. Brian Luke, meantime, is following bonds. And Michael, let's start with you.
Hi, Julie. Very quiet here. People just awaiting the Fed decision. The dollar index, it's been creeping slightly higher today. Right now, it's up around 74 points at last moment. Gold, it finished the day about $1.10 lower. It's still above the $1,000 mark, but right now it's a little bit lower, $3.50 lower, more or less. Very, very quiet. People waiting the Fed decision. Clearly, there was some action in crude on the inventory numbers, but very quiet on the commodity board. It was really about crude, not about the Fed earlier in the day. Otherwise, very quiet. Brian, anything with you here? I mean, it's been quiet on this side.
Yeah, Mike, when you talk about what the effect of the Fed results are, we're just waiting just a few moments away, but there was really, the bonds took a shot in the arm in terms of the 5-year auction. It sold off, and yields on the 5-year are now around 2.5% just a few minutes before the Fed announcement. 30-year bonds off about a point on the day, so we have a little bit of a small change in the effect. You don't talk about the big effect is with the mortgage-backed securities, and you see those mortgage-backed securities incremental risk, and you get paid to own those things. That has come down significantly on the year. It used to be 2.5% you used to get paid to own mortgage-backed securities versus treasuries. That has come down to a microscopic 1.015%, 15 basis points, and now it's crept up on some potential news on 30 basis points, and potential news about some Fed talk. So I'll send it back to you guys on this.
Brian, thanks a lot. And we want to get back to our roundtable as we wait for the FOMC decision. Expected now in just a couple of minutes. Alan Blinder rejoining us here, as is Vince Reinhart. And gentlemen, we've been talking about not only the statement, not only the decision, but also the programs that the Fed have been participating in, the purchases of MBSs, purchases of treasuries. Do you expect to get any news on that today? Michael and I were talking about this earlier, that the Fed has been coming out with that news a day later. Alan, what's your thinking on this?
I think it's kind of a coin flip, 50-50 bet. Not that much hinges on it. We know that the Fed is eventually going to make an announcement. It's almost certainly eventually going to slow the pace of the MBS purchases. It may announce that today. It may wait to the next. If I had to make a guess away from 50-50, I guess I'd guess that they do announce it today. But I don't hold that view with any great conviction, nor do I think the exact timing is of great moment to the Fed.
Alan Blinder joining us.